What my fear is only that do markets have such a big correction that people will never come back? There are many ways to make lots of money in the market. And there are many ways to succeed. But earlier data was not easy to get. It was very difficult. Today, the internet has made it so much easier. With AI, you can just go and ask AI, get me all the data for 20 years and it's going to give it to you. Formula One fan might say, oh, there's Max Verstappen. He's really fast and he's aggressive overtaking. Mutual funds tend up to be tax efficient in the sense you only pay taxes when you exit.
Welcome to this very special series where we bring you insightful conversations and even exclusive conversations with from some of the top voices from India's financial landscape, especially from the mutual fund industry. And today I have one such guest who's going to be entering the mutual fund space very soon, Mr. Deepak Shenoy of Capitalmind. Thank you so much, Deepak, for taking all the time to talk to us. With this series, we have been trying to understand the whole investment landscape and how mutual fund houses play a very key role into wealth management opportunity in India, right? And with someone like Capitalmind, who's already been in the PMS space, but now obviously getting into mutual fund house. Just wanted to help, understand where does the philosophy from like the PMS to mutual fund house, the whole like Capitalmind philosophy comes into perspective.
Great, Saloni. Firstly, thank you so much for having me. I think the problem with asset management is that you can do it in different ways. You can do it yourself. When you do it yourself, there are certain set of problems because I don't know which stocks to buy, I don't know how much to buy, and all that. You go one step ahead. You get an advisor, then you get a fund manager as a PMS. And because PMS is for the more expensive, for relatively, when I say most expensive, do you need 50 lakhs to start? What do you do when you're starting afresh? So we've built the PMS from the perspective that we want to charge our fees and build our model around something that is just management fee oriented. So we don't charge a percentage of profits or anything like that. We built our technology base right from the beginning to say we want to improve our performance, improve our compliance, and improve our customer service. And then on top of that, you tack in the mutual fund, you're able to access or help customers who have even less than 50 lakhs, sometimes 5,000, sometimes 10,000 as well to start with. The point about mutual funds in general are they're a way for you to access something. I want to buy gold, I can buy through a mutual fund. I want to buy equity, I can buy through a mutual fund. Mostly portfolio management services tend to be either about equity or debt, perhaps, but it's not very tax efficient in both cases. Mutual funds tend up to be tax efficient in the sense you only pay taxes when you exit, whatever you exit in, whether it's equity, whether it's debt, whether it is gold, and so on. So they're stable, well-regulated vehicles. So they tend to have a much higher barrier in terms of the strength of the fund house, the conviction of their strategies, and the rules they have to follow in order to be able to market something very, very specifically. So we're very keen on building for the larger India. And I think the scope of India is such that today we have about 18% of GDP in mutual funds. America is more than 100%. We have about, I think, we've gone up to about 30%, 35% of bank deposits as a whole sit in mutual funds. Again, in America and developed countries, it's as much as 100%. So we have a long story ahead of us. So as much as they are, there is the fact that there are already 45 players, there is the fact that there is so much more that India has to grow into.
Right, correct. We will get into the investment styles also in a bit. But before that, you are starting mutual fund in a space in India where obviously there's so many other mutual fund houses, right? This becomes from an entrepreneurial journey, right? You would just assume that it's obviously a crowded space. Then how do you actually go about, like starting your own mutual fund house? Now with you're obviously going to start with a strategy called as Quant, right? Just wanted to understand like how has that journey been and why specifically Quant as a strategy, according to you, fits right with India's growing landscape?
So fantastic question. Quant I'm a techie by background, so I like technology. I like verifiable information and all that stuff. So what happens to a large amount of the data that you have, as more data comes in, you need something to crunch the data and tell you what is happening. But more importantly, when you look at the universe of all of the stocks that are available today, what used to be a 40,000 crore per day transaction volume in India is now become 130,000 crores per day. Lots more people are transacting. There's lots more volumes coming from mutual funds, FIIs, insurance companies, retail, and so on. So because of this surfeit of, or large amount of data that you're getting from everywhere, there is a universal concept that as transaction volumes increase, markets tend to get a little more efficient, not inefficient, not fully efficient, but they get a little more efficient. So the earlier paradigms of perhaps traditional investing have changed into a form that says, well, you have to use the data to get some kind of an insight into information. So think of I'll give you the analogy that we're going to use, or we use often. When you select, if you're a Formula One fan, you might say, oh, there's Max Verstappen, and he's really fast and he's aggressive overtaking and so on. Or there is Hamilton, who is, long races and stuff like that. There's another person who's great at rain, and Alonso, who's great at something else. So you have people that you like. That's what the earlier concept was. I'm going to find the people and I'm going to search for them. I'm going to find the stocks. I'm going to search for them. That's traditional investing. You talk to management, you do a bunch of things. But what if I quantify it, saying, listen, aggressive overtaking means that there is a certain score I'll give you. So you're 1 to 5 in aggressive overtaking. So you're probably giving 5 marks to Max Verstappen, but you might give only 3 to Hamilton, and so on. So you might give scores for each kind of characteristic that you like. And then when I choose a set of drivers that I want, I will actually choose the characteristics instead of the drivers. So if tomorrow somebody comes in with more aggressive overtaking, I move to that person, or choose a portfolio that contains Max and that person, because I want an aggressive overtaking, in a certain race. So instead of selecting the players and kind of getting taken in by perhaps their brand values, and fact is most players outlive their performance. So towards the end, eventually you realize that portfolios, some stocks have reached their prime, and you need to select different kinds of stocks and so on. So quantitative is a concept where you actually go to the level of saying, listen, I'm not going to get enamored by the reputation and personality of something, but I'm going to actually look at the characteristics I want. And you could have multiple kinds of quantitative thought processes, because you can divide the market into, well, why does the market grow? You have simple concepts like, oh, my earnings have grown, so the stock has gone up. Or if you're looking at debt markets, that a company is more and more capable of repaying its debt. So because it's debt to equity ratio has become more this thing. So you can define these as factors and say, well, what's the score of a company in a factor called, well, momentum. Momentum is just price changes. Is the price changing very fast? Based on that, you give a score on momentum. And so that's one factor. There's a bunch of other factors: low volatility, profitability, value, which is it's cheap. Is a concept. Something called size as well. So you look at these factors, and you can look at them in isolation and say, listen, this is an interesting factor. Now, because I've chosen it in some kind of a defined thing, I can say, Deepak, why don't we go back to 2006? You don't have any data after that. So assume you don't have any data after that. Can you test the same thing that you're telling me? Momentum works very well. Does it work if I had selected the stocks in 2006? And these are, they're saying, like, listen, no matter when you buy them, over a long period of time, some of these factors tend to have excellent performances, even in comparison with the index. So that's now a worthwhile strategy to look at. Now, quantitative is an approach, so you have to change your mindset. So today, you're not saying there's a conference call. You should go there and ask questions. We are actually going to say, well, we may do that. We may go in and ask questions, but we are going to analyze this in some kind of a quantitative way. So it may be us analyzing the words that have been used to describe their performance, and use analysis to figure out if this is bullish sentiment or bearish sentiment, and then use that to make our choices. And we found that by and large, if you follow a disciplined strategy, that means you don't waver away and you don't keep running, but you have a very quantified way to select your factors and which ones you will use. In the long run, some of these strategies have in the past outperformed the index. So we hope that they will continue to. That's the approach we are taking rather than saying that we are doing traditional investing. Of course, I think eventually you can't do only quantitative. Correct. Because in debt you'll have a different strategy. In there may be a slightly different strategy when it comes to commodities and gold. If you're buying gold, you're buying gold. You can't do you can't not buy gold, because that is the objective of the fund, right? So there will be different types of funds in different areas where we'll have to operate slightly differently. But no matter what we do, there will be some layer of quantitative approach in everything that we do.
Right, like the way it happens in a traditional way, you're listening to these conference calls and everything. So I think that also is there, but the quantitative algorithm part also helps you, the data part also helps you.
There are many ways to make lots of money in the markets. And there are many ways to succeed. And I think you would agree with that in the career basis as well. There's no reason to say, oh, you've become a doctor, so you're successful. But if you become an engineer, you're not successful. Or if you become today a cricket player, you're not successful. I think each of them has varying degrees. So you can win in many ways in the markets as well. Traditional works, we've seen it work. Quantitative has worked in the past as well. We've seen it work. So I think everybody will choose their way to get there. So I will not want to say this is bad and that's good. We're just taking a different approach.
Yeah, because it's always interesting, right? Traditional way has worked, but you obviously have to find new ways also to strategize, the concepts, and quant is one of those. And also, have you seen India being there to kind of adapt this strategy in a way that it should?
In fact, I think the way that you want to look at the strategy is this. It's a different approach. You're still have a fund manager still looks at everything. So we need to have some on-ground experience.
Right.
Just because something is going up doesn't mean that it's a momentum qualified stock. Is India ready for this? I think India's always been ready for this. We like it in so many ways. And for instance, momentum, we call it momentum. But it's like in cricket, you say this person is in form, or in tennis, you say this person is in form. Why would I like, in the old days it was Boris Becker, and recently it was Roger Federer, and now it's somebody else. But the person who's in form is in form because they're winning. Now, if a person's been winning for a while, the chances are that they will win more. Because they're in form, they have the the strength or the ability to beat other people, but also the confidence. It's not very different with companies. If a company's stock price is going up, its employees are happier. They're watching, they're saying something great is happening here. And they are getting internal confidence as well. Their competitors are a little more afraid, saying, oh, well, there will be something great about this company and all that stuff. So all of this adds up to a layer where performance ends up getting better because you perform better, right? So this is part of our lives. We understand this, But, earlier data was not easy to get. It was very difficult. Today, the internet has made it so much easier. And with AI, you can just go and ask AI, get me all the data for 20 years and it's going to give it to you. So it's the availability of data has increased. The number of people trading has increased. Prices are more trustworthy. So I think India is the cusp of that stage where you can say that you can trust the data, and therefore you can build more robust algorithms that can access the market. We're not there yet where all of our a mutual fund can be run entirely by an algorithm. But one day even that will happen, I'm sure.
Yeah, and you also mentioned how the number of traders or other investors have been increasing in India, right? With the younger investors coming into the market, it's very different from, investor preferences from it was 10, 15 years ago, right? How do you see this strategy fit in for that?
It's interesting you say that, because if you offer anyone more returns, they will take them. So if you tell anybody, no matter whether they're experienced, old, young, everything, say that is 15% versus this is 10%, they will always choose the 15%. It is very rare that someone chooses the 10% and says, I'm happy with 10% and all that. But there are different types of investors. So for instance, the problem is we get to hear the more vocal people on social media and all that who say, I've got 40%, I've got 80%, 60%. But the difference between 10 and 12% is not meaningful enough for most people to make that choice and decision. And you find that a lot of the younger people who are very silent are more like, listen, give me something that is reliable and I can trust and will beat inflation over the long term, at least at some level, and I'm happy because my job is to earn money and I have to save money and I have to build my career and all that. And they are the silent savers. So of the 26,000 crores that comes in SIP, I'm thinking probably 20,000 crores come from here. Maybe 5 or 6 comes from the people who are chasing some return or the other. But many times they have this problem of, I chose one, it didn't stop performing, I chose the other. In the past, we used to get a lot more of these cycles where you would have a bunch of people when the markets were going up, they would come and they would buy and they would make some returns and think they're geniuses and then put all their money, and then the markets would go down and they would lose. And it's not abnormal losses. Our markets are supposed to fall 30% every 2 or 3 years. But when it fell 30%, they got so disillusioned, they took their rest of their money out and said, markets are a fraud, we want to come back, right? But the last 5 or 10 years, that has changed. The younger crowd is actually a lot more, let's say, resilient. So, people my age, a lot of people have entered the markets and given up. The people who are much younger, who are in their 20s and 30s today, have actually seen markets relatively not as volatile as they were in the past.
We have been like one of like the party phases
of the thing. But even when markets fell 39% in COVID, they actually put more money, not less, which was so surprising to me. So something has changed, and perhaps we give them the young people less credit than they're worth. We keep thinking they are these aggressive types, but maybe they aren't that aggressive types. They are the kinds of people who are saying, I'm here for the long term. We can invest.
Right. But with all the optimism that we talk about, obviously there are uncertainties around as well, right? Especially with every year you see some sort of geopolitical risk coming in, or, obviously there was another, like inflation was a concern before. Now, obviously it's much better. Now, with all these factors in mind, like how do you try to adapt that into the quant style of, strategy? Because when it's active, it becomes easier for you to kind of keep changing. But I like don't know how it happens when you were trying to do it with data and algorithm.
Oh, yeah. I mean, so for instance, any data that you think impacts your algorithm, you can test. So, for instance, is inflation rising? What happens in a rising inflation market? I could backtest that and say, well, does my strategy work in a rising inflation market? Or does it work better in a falling inflation market? The answer we found is some of these factors have no impact on performance. So, the way people react to news and the way markets react to news also has changed. So you have to change your strategies accordingly. You can't say that, listen, just because some event has happened, that markets are going to go down. Instead of predicting, you would respond and say, well, has it gone down? If it hasn't, then maybe it's not going down. So that's the answer that you want to find. And you don't want to make these assumptions based on the past. But lots of data will change. And when data changes, you would, like, for instance, I think the US interest rates are at relative highs compared to last about 10 years. So we did the analysis to say, well, what happens if interest rates go up? The answer is it doesn't matter for the most, even for the US market. It doesn't seem to matter. It matters for a short time. And then it stops to mattering in the long term. So there is some factors that you should use to look at your data, but you should also be very aware that they can be noise. And most news is noise. Selling because someone else is selling is a bad idea. Buying because someone else is buying is also possibly a bad idea. So that's not a factor that you should be using to fund, to drive into your investment philosophy. But instead, you might look at other factors and say, well, you know what, there's deals happening. There's exports of certain items from India is increasing, and this is the number one supplier. I could look at the export data and say, well, you know what, this company is seems to be exporting more because I'm looking at other countries' imports and they're importing more and more from India. So those data actually have more meaningful impact in your analysis than you have some of these macro elements. A lot of data is just noise, and we like to over dramatize our lives. So somebody will make this big thread on how inflation is destroying India's economy and all that. Then you look at it 6 months later and said, what destroyed? We're still here. So, at some level, it's, you have to let data help you make your choices. But you also have to know which data is data and which data is noise.
Right. As you mentioned, right, most of the times it's a noise that kind of creates the panic. But when you look at certain data, that I've even seen you on, like LinkedIn and Twitter talking about how data says something else. Like it's not even being show that sort of reaction that you think it will show, right? But now that you're going to be launching, like the funds pretty soon for the mutual fund house, just wanted to understand in general, what are the risks or fears, keeping India in mind and obviously the global scenario in mind, would you be thinking of? Because obviously you have to be very watchful for all these steps, right? As in when you try to build your business in the mutual fund industry.
Oh yeah, so I think lots of risks always exist. There's always going to be a risk, right? So there's geopolitical problems that can lead to business disruptions. They can be core underlying risk. We are very bullish on the Indian economy because I think India has been very favorable to entrepreneurship, to people who have set up businesses and so on. That's why me, as a single guy from with no, with no surname that is already well known, already
or no backing from
the big, so
big
I think
names.
that the fact that I can do something in this country is a boon. So it's just about what data you incorporate. But I mean, as much as I fear anything else, what my fear is only that do markets have such a big correction that people will never come back into the markets? Because even if they don't come back, the markets in the long term, I think, will do well. But it is the choice of an individual to say whether they'll participate or not. You should not leave disheartened. I mean, walk away completely from something.
Thank you so much, Deepak, for your time, and really looking forward to all the new funds that you'll be launching, from your new mutual fund house, and wishing you all the best for that. And we will see you in the next episode.